Next move on rates, we want to bring in Lindsey Piegza. She is chief economist at Stifel. This is probably not a surprise what we're hearing from Kashkari this morning, Lindsey. This sounds like what the Fed has been kind of signaling over the last month or so. So maybe not a shock to the markets.
No, certainly not. Kashkari is just one of a number of Fed officials that have been reiterating not just this broader message of patience, but really quantifying that message to suggest that it's not just a need for several months, but many more months of improving inflation data before the committee could justify a reduction in rates. Now, the Fed still maintains that easing bias. The Fed still maintains that the next policy move will most likely be a rate reduction eventually. But with just a little over half a year left, eventually does appear to increasingly be a 2025 event.
But that maybe is not necessarily a problem. I mean, the market was looking for 6 rate cuts at the beginning of this year. It's come down to the idea where we're used to the idea of 0, and it has not impacted the market's performance. Is there a point where you think that changes?
I think the pivot point is if the Fed needs to shift their message from eventual rate reductions to possibly re-engaging in rate hikes. Now, we did hear Kashkari allude to that somewhat, but most Fed officials have been continuing to toe that line regarding the expectation of the Fed's next move being a rate reduction, a move to the downside. But again, that pivot point for the market is if we start to talk about when the Fed not just delays rate cuts, but considers actively re-engaging in further rate increases.
What's your sense on inflation at this point? Would that be necessary, or you think if the Fed just kind of pauses and looks around for a while, that the inflation issue will be dealt with?
Well, there's 2 different scenarios. If inflation remains at the elevated levels or even pushes slightly higher from here, I think the Fed will simply maintain their position on the sideline. But if we see a less favorable scenario play out, if we see inflation continue to rise away from the Fed's 2% target, well, given the Fed has a very, very distinct dual mandate, stable prices, full employment, if we see inflation moving away from that stability target, the Fed will be backed into a corner. Now, the Fed won't like it because it does risk their credibility, or at least calls into question their terminal rate decision at 5.5%. But again, if inflation does appear to be moving away from the target, they will be backed into a corner and forced to potentially raise another 25, 50 basis points or more, depending on how precipitous the backup in inflation becomes.
So on Friday, we're looking for the PCE. Expectations are 0.2%. People are saying if it's 0.3%, that's going to be hot. But we are also talking about potentially carrying out an extra decimal place. Is it 0.25, 0.24, 0.26? I mean, that's not necessarily the stuff that is going to make the market think, uh-oh, if it's 0.26, that's not necessarily a rate hike coming next, right?
No, certainly not. 1/10 of a percentage point is not going to shift the Fed's overall thesis that inflation will eventually reemerge to that disinflationary trend. That being said, every additional data point, every additional month of hotter than expected inflation moving away from that thesis does begin to gain credibility for the alternative argument that the Fed, with a hyper focus on achieving that utopic soft landing, did stop short of a sufficiently restrictive level to tame inflation, and builds credibility or builds evidence that the Fed will need to eventually re-engage in further rate hikes. So one data point, not enough this week, but it does potentially add to that conversation as we approach the second half of the year.
Lindsey, we are expecting the ECB to actually cut rates in the coming weeks, next month. That's a big deal if we are going to be seeing us not cut, them cut. It's the first time they'd be leading. It could mean that it's them importing inflation by doing that because the euro could come under pressure. How does that change things if the central banks aren't acting in concert?
Well, I think what we're seeing is central banks responding to their own domestic economic conditions, where we've seen significantly weaker growth overseas. coupled with, yes, still elevated inflation, but certainly not to the peak levels that we saw in the U.S. So early on, it was very evident that the Fed had a larger job to do, and potentially stopping short, as I mentioned, of that sufficiently restrictive level has allowed growth in the U.S. to remain more positive than many of our developed counterparts, but it also gives us less confidence that we will see inflation recede more precipitously, as we have seen in some of these other larger economies abroad. So yes, the divergence does put pressure on the Fed to move in tandem, but at the same time, given the differential between these growth and inflationary scenarios, it makes sense why the ECB would be moving at a quicker pace towards easing, while the Fed still appears to have quite a bit of wiggle room or timeline on the sidelines.